Today's a fun one. I'm going to go through a portfolio here live, show you exactly how it's off, how we can get it towards our system, what I think is good and bad, and how we can also look at the macros because that's the most important thing right now, given the market conditions. And this student is not aligned with the macros, so there's almost no cash. That's a really big red flag, given what I'll show you at the end of the video, what I'm most nervous about in the markets. The other thing I see is that there are too many positions. So 15 positions. That's way too much. This is fine if you're winning, right? If you're in a good market, you can get away with this because likely the rising tide lifts all boats. But in a tough market, in a market that's flipping, we start to see losers and we start to realize we had no plan. We have no plan in the future, which is a bag holding strategy. It's a collector's mentality where you're just going to end up holding stuff and creating these dead capital situations where you're in the markets, doesn't go in your favor, and then you end up holding things that are just garbage. And then over the next couple months, you just keep holding them. And at some point, you just never stop holding them. Some people hold things for years and tie up capital that could be making money. So recognizing when things are gone and against us and not a quality name is the most important thing to do for everyone watching this video. Because if we could take our money out of the things, crushing our returns, tying up capital, and put it in things that are actively in better trends, better areas to enter, and better structural trades that are safer, we can get ourselves out of the money not making money and put it in the right place. And that move alone is the only move you need to know if you want to be successful and gravitate towards our system. So the money at this point for the student is 80% CSPs, 50% stock. And obviously that doesn't make sense, but this is based off his loss too. So it's probably like 20%, 30% stock. The reason I'm flagging this today is because stock ownership at the wrong market timing is awful, especially if it's a bad stock or a leveraged stock, which is kind of what we're going to see next. But if we do not time the markets correctly and we get into stock and we have no cash, we end up tying up our hands, having no moves available when the discounts come. Because the ideal scenario is the markets crash and you're deploying the cash actively more and more and more and getting that discount. That cost base is so low that you're set up for the best rally ever. Because there's a difference in the market of the 6 bull markets that we see or the 6 bull months that we see back to back to back. I'll show you an example. If we look at triple Qs and we go to the monthly chart, like this was 1, 2, 3, 4, 5, 6, 7, 8 bull months in a row. There's a difference between how we look at that, how we analyze that and trade that versus this candle, this candle, this candle, this candle. These are all flat and down candles. So I would not be looking to have no cash at those candles. I would be looking to have no cash during these candles, and recognizing these is not that tough. So what I'm trying to tell you is there's a time to take a risk. There's a time to take a better stance in the portfolio for ownership. But if you take it at the wrong time, you're going to tie up your capital and not be able to deploy on the dip. That's the most essential lesson of this video is if you can recognize market cycles, market movements, this is the game changer for making the returns during the best markets and trying to push them up in the biggest way. Because if you position yourself with a cost basis down here, you're maximizing that 26% push. But if you got in at the highs, not only do you wait with dead capital for 4 months, but when the market pushes, you're only making 20% versus 26 or versus 20. I mean, at the true bottom, it could be 28, 30. So you're giving up the money because you're in at the wrong times. And timing the markets with the actual candles and the actual moments where it's high risk and statistically against you is a next level that's very tough to get to. But what you need to understand is the first gauge to know that you're doing things wrong is if you get into a place where you're owning stock and you're consistently at a loss. That's just telling you your timing is off. So let's look at this portfolio. This is, we're seeing here Netflix, Bitcoin down 60%, 60%. And these are leveraged ETFs. And this is a huge red flag because this is where we can get into a dead capital scenario. We're holding something, it's going against us. And once it passes a certain threshold, it's likely to tie up our capital for long periods of time, if not drown our capital to zero forever. Certain stocks will do that, which is the biggest fear when people are getting into the wheel and learning things, because choosing the wrong stock can massively swing the results. And I've been pointing this out for probably like 7 months. Is Netflix is a AI disruption play, right? So there's going to be obviously movies and shows made with AI, as that's a big picture idea. That's like 5-10 years out. So that is a headwind. People recognize that with Netflix, and the institutions will position out. So when I look at Netflix, I don't look at the trend yet. I don't look at the play yet. I look at the macro. If it has enough legs to hold itself and survive, it hold its moat in the future. And the other thing that would have hurt Netflix, aside from AI, is the competition. Amazon, Hulu, Disney Plus, like all of these platforms are making it so Netflix couldn't raise their price. Because what's the difference between $20 with Disney Plus and if Netflix was at $50? The difference in content is marginal, but the difference of price is huge. Why would I pay triple for Netflix? It doesn't give me triple the value. So at this point, it's a race to the bottom. It's a commodity product. The margins are going to be like 3-5% over long periods of time. So this is a company that's getting their moat destroyed. Their margins were like 20%. Now they're only going to go lower because of competition and now because of AI. So when I look at this as a big picture, I do this on every single stock that I know. If I don't know the stock, if I can't do this, I just tell myself, don't trade it, don't hold it. And if people are holding stuff that they don't understand at a high level like this, they should do the same thing. Don't trade it, don't hold it. So Netflix, aside from that, has been falling and falling and falling, which is telling us we are in a bear trend. So I tell a lot of my students to add the Ripster clouds, right? So the Ripster clouds are going to visually show a trend. And we can see here a red cloud and a yellow cloud. So those are the bear clouds for the weekly chart. So the trend is broken. The stock fundamentals are broken. I think we recognized this on the first drop, and people had a really good chance to get out here, but a lot of people bag held and they're still bag holding, which again takes capital out of our system that could be making money, that could be safely generating something. So not only does the capital in Netflix drown and get lower and lose money, but the cost benefit of being in Netflix versus being out of it is huge because of what we can produce with how we teach our students the wheel. So when I look at Netflix, this is a big red flag. We have multiple factors against us that will create a dead capital situation where it's tied up and it's hurting us and it might not stop. So if we look at a stock like a Lucid, this is a stock that has been trending down forever. No matter where you bought this stock, you're likely down 80 to 90%, right? So this is a play that is consistently taking your capital and making it smaller and smaller and smaller almost every month. It's the reverse of the system I'm trying to create. This is lowering your account every month. We want to teach you how to raise it. So being in stocks, if we can recognize these trends are against us, these fundamentals are against us, we can start going towards things that are better aligned. So aside from that, Bitcoin, the entry is god awful. The last price is like $20 away. I believe in the Bitcoin bottom today, but getting in early with the trend falling is really tough. So the only difference I would say for this student is, hey, listen, I know you got in super early. You have to decide if you want to add to create a lower cost basis, a bigger position, so that we can take advantage of these levels, or do we want to move to something we truly understand, we truly believe in? Because yeah, the issue here is we're just going to tie this up for probably 7 months, maybe a year because of the entry. It's so high and we're so far away. And the chance of hitting a 200% run from here is very small over a short window of time. Now you're looking at a 2-year out play, which now we're juggling this. Do I take the money out, put it in something that can make 5%, or do I keep it in this and wait 2 years just to break even? Like, that is the other scenario. So the other thing I'm seeing for this student is in terms of capital allocations, these are all pretty small for the leaps, which I love. People who get into leaps go too heavy, wreck their accounts. You got to be under like 1-2% just to learn the leaps. The other things here are Google and Tesla. The issues, again, as we're seeing, guys, is it's fine to be an owner of a stock, but we have to understand the market conditions. If the markets, the stock market, the index funds are about to roll over and they're about to get ugly, we really don't want to be owning stock. And we certainly want to be owning something we can position into. So it's fine to own these stocks as long as we have a plan to buy a second leg, a third leg of an entry, versus just buy one and hold it, because that's where the Bitcoin trade will crush us. We're tying up capital for years, but if we're able to position in, even today, our cost basis goes from 34 to like 24. So that's a more achievable trade to break even. And if you keep buying more and more and more, you might get your cost basis to like 18. So the issue here is the one buy strategy doesn't make sense because the markets are unpredictable, discounts come in, and if you can't take advantage of a discount, it really doesn't help you. Other than that, a lot of this other stuff is in our low risk category. Our software can analyze it, tell you the risk level of what you're holding. You can see these are threes, ones, ones. So our software's already kind of checked this for the student. These are not positions I'm worried about because number one, they're selling puts, which is our core thesis for our program. Everything outside selling puts is obviously higher risk and has been flagged. So you can see where the student's doing well and how they've got off the rails, but hopefully this analysis can help you really dissect how we look at the markets. The other thing I want to point out, guys, is realizing the macro movements is very important. So if you look at the markets, typically, if you study seasonality, September, August is where the biggest sell-offs happen. And then you also have May and April. So this is where I have studied and planned my portfolio to actually take advantage of this and reposition how I look at the markets around these periods of time. This is one of the best pro hacks versus looking at RSI versus looking at indicators. No, just looking at seasonality and understanding that August is not a fun time. September is not a fun time. And if you can just have cash, this is the benefit. If you can avoid owning too much stock, this is the benefit of knowing these times because you can just adjust slightly those two things. And now you can take advantage of the entry, the dip, the discount. And when we use the leverage ETFs, you can see my pullback areas are already marked for the students. That return difference I showed you earlier, where you're in at the highs and you're bag holding for 4 months and then you make 40%, the return difference of getting in lower is double. I mean, you're making 90% from the bottom versus 40% getting in at the top and bag holding stock. So the power of cash entries towards specific areas is very, very important. Hopefully this helps you. If you like this video, comment below. If you want to see more portfolio reviews, also let me know below. Just give me a thumbs up or a yes, and I'll drop another one next week. Peace, guys.